Hi, everyone. I'm John Carvello, president of Stone Oak Capital and Divestopedia. I'm so excited for our discussion on the landscape of private equity for middle market M&A. I really hope this discussion highlights the diversity of private equity available in the middle market. And I also hope that this discussion brings us and highlights different types of transaction scenarios that our guests participate in. We do have an amazing group of private equity professionals joining us. Jeff Kadlik is founding partner of Evolution Capital Partners. Heather Madlin, partner business development at Huron Capital. Glenn Oken, founding partner at Mangrove Equity Partners. Welcome, everyone.
Thanks.
Thank you.
Thank you.
Having us with you.
Before we start, I'll let our audience know that if they have specific questions, they can get them in, and we'll address those towards the end of the hour. So just to start here, Glenn, I'll start with you. Maybe you can provide, for context for the audience, give us an overview of your firm and the investment criteria that you deal with your transactions.
Sure, John, thanks. So I'm fortunate to work with some terrific people and partners at Mangrove Equity Partners. We're a lower middle market private equity fund out of Tampa. We're not newbies to private equity. In my case, started in 1989, working out of a ninth fund, the third under the Mangrove banner. And when I say lower middle market, to us, that means investing typically in the majority of companies in the US and Canada earning between 2 million and typically 8 million of EBITDA. We've been in over 60 industries and over 140 partnerships and transactions. And we're pretty opportunistic, but by and large, they have tended to be in a few buckets to include non-commoditized industrial product manufacturing, mission critical industrial service sectors, enthusiast-driven branded consumer niches, and often consolidatable business-to-business service sectors. We're a little odd in, especially the lower middle market, in that decades ago, we had a stroke of the obvious that private equity really could benefit, especially entrepreneurial company, private equity investors could benefit by having internal operating capabilities. And we invested half of the ownership in the firm in a 4-partner internal operating team that includes a second generation Deming disciple, a bunch of engineer operators.
Awesome. Thanks, Glenn. Hey, before the call, you teased us with where you're at. Maybe you can share with our audience a little glimpse of where you're sitting at.
Make everyone jealous.
It's terrible.
Everyone in the north.
Well, this is a yard that got trashed in a tropical storm a couple days ago.
We can't tell it's trashed, Glenn. Don't worry.
I know.
It looks
I know.
It just looks gorgeous to us.
Dolphins don't care.
Jeff, do you want to share with us an overview of your firm and the investment criteria that you're involved with?
Sure. Yeah, we're Evolution Capital Partners. We are in the micro end of the space, which are investments that are generally under a $50 million valuation. I'd say our average is about $6 million. I would say that our strategy is, to use a baseball reference, the farm system for the big leagues in terms of the private investment continuum. So we're really trying to work with founders who want to professionalize their business, to grow it, and to also maximize the value of the company when they ultimately sell it. We were founded about 15 years ago, and we're investing out of our 4th private equity fund.
Great. Thanks for joining us. I won't ask you to share your surroundings there.
You know what? It's actually not that bad. I'm pretty proud to be in Cleveland. I'm looking at a lot of buildings, but
this is a nice view
today.
Heather, same question to you. Maybe for our audience, can you just share, an overview of your firm and investment criteria?
Sure. Thanks, John. So Huron Capital, we're a 20-year-old middle market private equity firm headquartered in Detroit. My view is not nearly as nice as theirs. I am in the suburbs of Ann Arbor, Michigan, so I have a bunch of trees outside. But we've been around for 20 years. We've raised 6 committed funds totaling over $1.8 billion. We go to market via 2 strategies. One is our flagship strategy, which is our buyout fund. And we're investing kind of control equity at interest in companies with more than $8 million in EBITDA. Our Flex Fund is the second strategy, and it's a smaller fund, and we're investing both control and non-control equity investments in companies with at least 4 million in EBITDA. Both funds focus on three kind of big industry sectors, though we are becoming more focused in our approach, which we'll talk about later. But business services, particularly commercial and industrial services and human capital services, specialty industrials and consumer products and services as well. We do tend to be operationally focused. We are founder owner focused as well. And finally, our MO as an organization is to buy and build through add-on acquisitions. And so of the 200 plus deals we've done in the last 20 years, over 2/3 of those have been add-ons to the portfolio company.
Great.
Portfolio companies.
Awesome. Thanks again for being with us today. Jeff, your firm has a really interesting strategy and investment thesis in dealing with smaller end of the lower market, middle market. What's attractive about that space for your fund?
I think the thing that's most attractive about it is the fact that the valuations remain, very stable, regardless of what type of where you are in the economic cycle. When we got started, I used to call the space that we invest in the capital gap, and you could really see it in the valuations relative to venture and also relative to middle market private equity. And I think that really is the result of two things. One is that the capital markets or leverage really don't play a real role in the companies that we invest in without personal guarantees. So our strategy is a low leverage strategy. And I'd also say that the valuations remain relatively stable because the professional investment community is largely overlooked, the space that we invest in. And so, the supply of companies is obviously a lot greater than the amount of capital that's pursuing them. So with a low leverage strategy like this, we're really relying on that multiple expansion. And that really is protected by the fact that there's this $1 trillion plus of committed yet uninvested equity capital and a robust leverage market that allows us to kind of buy in at this 4 to 5 times range. And if we can put together a growth strategy and get it to call it 3+ million of EBITDA, we can get a 6, 7, 8 times multiple on that. So that really makes up for the fact that we are not using a whole lot of leverage in our strategy.
And the exit strategy. Sorry, Glenn, go ahead.
No, after Jeff.
Yeah, I was just going to say your exit strategy then is to another private equity firm that deals with a bigger business or a strategic, or what's the exit on that?
Yeah, it's both. I mean, as I said, we're kind of the farm system for the big leagues. I think we do a lot of things that larger private equity funds aren't, I hate to say aren't equipped, because I don't mean to intend that they're not smart and talented. It's just that they don't really want or need to get into the details that we get into. I mean, things like a lot of the companies that we invest in early on really have no meaningful finance and accounting function. They don't have a go-to-market strategy. They don't really do budgeting very well. So very fundamental things that really make them, frankly, difficult to deal with for a lot of more professional organizations.
Mm-hmm. That's super interesting. You don't see a lot of private equity in that lower middle market space. Heather, Huron Capital has a minority equity investment strategy. Can you talk about that strategy? And it seems like there's an increasing trend of PE to participate in a minority position. I know that you guys were one of the first, and when I first saw it, you remember how many years ago, I thought, wow, this is a really interesting strategy to play in kind of a minority position, which isn't usually the case for PE.
Indeed. Well, first of all, I have to comment on all these people who are posting here. I've seen Italy, Greece, Serbia twice, and a bunch of places in Canada and the US. So it's kind of fun to know what kind of global audience we have today, John. So yeah, we established that strategy about 3 years ago, and it was really meant for the business owner that was seeking an alternative to a sale. They wanted a more committed sort of private equity partner that brought all the resources that a traditional fund would bring to bear for a controlled transaction, but in a non-controlled transaction, and solve some of the issues that business owner might have. Pay out a minority shareholder that was not active, raise capital for an acquisition, but they really wanted to maintain control and sort of bridge to a sale in 2 to 3 years once they had accelerated growth in their current business. So, and that model, I mean, still works today, but as you mentioned, John, I mean, we're seeing a market increase in demand for this type of capital. That fund alone has seen a 50% increase in deal flow since last year. So we're seeing kind of the evidence of that in our own deal flow. And I think there's probably 3 big reasons for that from our perspective. One, and this seems obvious, but I'll state it anyway, there's a growing number of companies that are choosing to delay their pre-pandemic full exit strategy for at least a couple of years, whether that be because they were impacted by COVID or economic uncertainty, warrants waiting for a little bit longer. But, these guys are electing to take a minority deal, raise some capital, diversify their liquidity, and get a growth partner and wait to sell for 2 to 3 years. And what's interesting is we're seeing a greater number of investment banks who are marketing these deals. They're marketing both control and non-control options. So they're asking, folks to provide both if you can. And so we're doing that because, folks want to see what their company might be worth at a full exit, but then also know that here's my plan B as well. And so that's been interesting. I think the flip side to that, which is something we're seeing with the company we have under LOI for Flex today, is the opposite of that. Some companies are growing tremendously as the result of COVID or some other issue. For example, the company we have under LOI is doubled in size from 2019 to 2020, and they're in the logistics space, and they're definitely benefiting from the Amazon effect. And so they're projected to double again in 2021, and the owners of that business simply don't want to give up control today. They know their business is growing and will continue to grow. They have confidence in that. So they really want a partner like Huron to come and give them advice for how to prioritize that growth, how to, make that growth more efficient, and get a larger kind of second bite at the apple at the right time. So that's the second bucket of opportunities that we're seeing. And then the third would be sort of, good business, bad balance sheet businesses. So over-levered, upside-down balance sheets. We're starting to see more and more of those. We certainly don't do distressed at Huron, but we are starting to see those situations where they need to refinance, but it's going to open up a hole in the balance sheet that could be filled by a preferred equity investment like Huron provides. So those are kind of, 3 of the big reasons that we're seeing an increased demand for that type of capital.
Yeah, really interesting. I always thought that, somebody that's looking for a minority minority partner just has a different mindset, right? Like they want to keep the equity because they're looking to grow. So that's interesting that, I was actually surprised that trend hasn't started earlier, and great on you guys to identify it and really take advantage of it. Glenn, let's talk about Mangrove Partners, and on your website you talk about partnering with independent equity sponsors. So maybe to start off, can you just tell us what an independent equity sponsor is, and then what is the opportunity within investing with these types of partners?
Okay, sure. It's certainly not the majority of our playbook, but there's a page in our playbook. We've had the good fortune of partnering with a handful of really qualified independent sponsors and a handful of deals. And the idea basically is these are folks that have skills, maybe it's investment banking skills, private equity skills, or operating skills, and they can find a quiet deal. And that's sort of a requisite, that it's a deal that we did not see and we're not going to see. And they're looking for the ideal partner. And what we are looking for are folks who, one, again, show you a quiet deal, but also their value add. They may be a force multiplier with respect to execution or operations. Frankly, probably rather the latter a little bit. Or we've seen them be very effective in a roll-up, for example, picking up a mantle with respect to finding add-ons and doing some of the execution work with add-ons. We have a very deep team, so we have plenty of capacity, but it's very nice if someone can both bring you an idea, bring you a deal, and then get in the trenches with you and work to make it successful. The transaction, candidly, it should be at a relatively reasonable valuation, because when you add independent sponsor economics on top of that, that would be important. And I think that our independent sponsor partners would say that we were a pretty good choice for them. And one was, in fact, a repeat offender with us. because of the internal operating capabilities and just the capacity and experience. I mean, those guys are going to have a fairly concentrated portfolio, most likely. And so the ability to reduce risk would be helpful, and the opportunity to optimize, enduring value and really hit the ball as far as can be hit with each portfolio company might be key to them.
Mhm. Jeff, do you have any experience with independent sponsors in kind of that, smaller company space?
To be honest with you, there's just not enough economics to go around.
Makes sense.
In the small deals. I mean, it just, because they need income as they deserve. If they're going to contribute to the deal, there's just not enough to go around. And as a small fund ourselves, we really rely on portfolio company fees, and we work hard to add value to earn that fee, but there's just not enough to go around.
Yeah.
I'll second what Glenn said. We're seeing that, particularly out of the Flex Fund, another just organic way that's growing, not COVID driven, but 2 of the 4 deals we've done in Flex have been partnering with independent sponsors. And, at that $4 to $6 million range, the math works to be a minority partner and give them control of the deal. So it's been an interesting, growth path for them as well.
Yeah, oh, that's great. Heather, maybe I'll stay with you here on our next question. So, what are some of the challenges that you're seeing in closing deals in this current environment with COVID and lockdown and restriction to, access to maybe site visits? Maybe talk about doing deals in this current environment.
Yeah, I mean, these guys are going to have some examples too, so I'll keep this brief. But we've certainly seen, I would say, challenges, but probably more efficiencies, candidly, from a diligence perspective. So, I'll give you a great example of that. We sold the majority interest in a company called Intervision this year to MidOcean, and that's public. But we did when we were raising capital on the debt side, MidOcean, the lender meetings were all virtual. So think about how that's better. It doesn't limit the number of people that can participate in a management meeting. You don't make them visible on Zoom. You make it a webinar presentation just like this, so you don't know who's participating. And then you have an associate moderate the Q&A from the participants, and you can get a lot more people, a lot more information more quickly, and probably get potentially a better deal as a result of going a little broader with more information to those guys. So that's been a nice kind of efficiency. I would say, most of the deals we've done since COVID have been add-ons. We've closed 15 add-ons since April across 5 or 6 portfolio companies. And I'll tell you, diligence tends to be easier for add-ons. And so thus is why we haven't really slowed down that activity very much, especially when you know the industry, you see the impact of COVID in your own business. It's easier to underwrite an add-on at this point. And also, if they're in the network of the management team, they likely know each other already. So that need to have a virtual management meeting is probably less, less needed, less required than it would be for a platform. Because I think, the management meeting is decision in person or virtual is pretty binary from what I'm hearing from my PE brethren. Like either you are comfortable doing it or there's no way you'd be comfortable buying a platform. And I think we fall into the latter end of that. But we're making it work. We have a big platform under LOI right now. We have done on-site QofE due diligence for that. And we've just gone out there in smaller groups, like one at a time, so that we can limit our exposure and be a little bit safer. I think the other challenge that I'll address real quick and then punt it back to you guys would be the challenge of economic uncertainty and how to value and underwrite these businesses. We've gotten pretty creative. Where we've seen the most add-on activity is for our insurance brokerage business. And so I'll use that as a good example. We created something because I think structure is being used more readily to de-risk an investment given the economic uncertainty that we see in the future. And I think one way we've done that is to create what we call a maintenance earnout. So, there is an EBITDA hurdle, but it's the same as this year as next year. So there's no increase to that hurdle that you would traditionally have for an earnout. And so that usually ends up being a turn of the purchase price that's deferred for a year. All they have to do is sustain EBITDA. And so that's helping us de-risk some of those add-ons. On the platform we have under LOI, I have to say the earnout is not meaningful. It's about a half a turn. So, that isn't as impactful from a platform perspective for us, but that's been interesting too.
So that's sustaining EBITDA at the depressed level that in order to turn to.
Well, some of these insurance agencies aren't, really feeling the impact of
Okay.
COVID. I think it's one of those essential products that you always have to have regardless. And certainly M&A may impact demand going forward. And so some of that uncertainty is the reason why we're putting some of that structure in there today.
Yeah, and it totally makes sense that the add-on acquisitions are the ones that are getting done. And I never really thought of that, but you already have familiarity with the industry, with the platform. So doing the add-on is probably feels like it's less risky in this environment.
Indeed.
Jeff, you want to give us your experience on just the some of the challenges that you're seeing in this doing deals in this environment? Anything from due diligence to forecasting to valuation?
Heather made a really interesting point, and that is it's actually not as difficult as one might think. At a fundamental level, I think it hurts people that are natural salespeople that want to be in the room with somebody to kind of engage with them on more personal level. But for which I like to do, I like to be in the room, but I found that when you've got somebody on the other end that is very forthright about their challenges, it really helps break that trust barrier, which is really fundamental to getting anything done in life. And I'd say for us, it's probably a little bit easier because the businesses that we invest in are service businesses for the most part. And so there's really nothing to look at other than meeting the people and hearing their answers and that sort of thing. They're relatively simple, small things. We did get a deal done here in August, and we started the process in March. Finally met with the management team right around 4th of July for a few days. And then we had planned on going back, and they said that some of their management team are really concerned about COVID, and you want to obviously respect that. And so we said, okay, let's just see how it goes. And it just kept going. And we do video calls, and we would meet multiple times a week, and the company was prepared. And their representation was very professional, and it worked. I can see doing it again and again and again, frankly, for the kind of deals that we do, provided that the team, that's the management team, is very forthright with what's going on in the company.
Mm-hmm. And are you seeing, as Heather mentioned, earnouts in transactions, or what kind of deal structure are you seeing? Has that changed?
To be honest with you, no, we really have two structures. I mean, we have to keep things pretty simple. We don't have a lot of multiple syllable words in our LOI and stuff like that, because these groups are entering into our world. And so we need to make ourselves more palatable to them in terms of we want to make sure they understand what they're agreeing to and what they're getting involved in and that sort of thing. So we really, our entire energy is focused on the kind of company and kind of founder that we want to work with and going forward. And that trust that you need to build starts right away. So I guess as I'm thinking of it, what we have gotten much more sophisticated about is formal presentations. So in every step of the way now, we have a slide presentation where we kind of stop in our due diligence checklist and say, okay, now's the time that we tell them the next steps and what our current thinking is. And that level of communication has helped, because as I said, we need to trust them, but they need to trust us, and we need to earn that, really from the first meeting. As far as valuations are concerned, it's actually been really simple. Most of the time, we just kind of take their March, April, May of 2019 and replace it for 2020.
Okay.
And say, as long as the business hasn't been damaged
That's great.
permanently, and most haven't, we just kind of replace it and just say, okay, and it's worked out.
Mm-hmm. Oh, that's fantastic. Glenn, you want to share with us, some challenges that you're seeing on closing deals in this environment?
Yeah, yeah. We have been delaying personal visits a little bit later in the process, but then we absolutely need to go visit with people. We're partnering with teams, we're partnering with the entirety of their employee base. So we do get on airplanes and we're visiting. We've closed a platform and an add-on the last couple months, and we did have in-person visits in each case, and things that we're working on that are under letter right now, we're visiting in person. We're pretty conservative regarding COVID. We're being careful. But in all honesty, you really don't control the environment in somebody else's backyard. So that's an issue, but we're doing it. Again, just pushing it back a little bit. We're being very mindful with respect to COVID spikes and COVID dips. And as Heather mentioned, we're willing to use structure to make sure that a seller can stay whole in the right circumstances. We're willing to invest a whole capital stack and not rely on the debt markets if the debt markets prove to be uncooperative for a little while. But we've had good luck with lenders in this environment on the things that we've closed. So we stayed active through 3 decades worth of major dislocations, and this is certainly a different one, but we've stayed quite active through this too.
Mm-hmm. What are you seeing on deal structures and use of earnouts and valuation levels?
Mm-hmm. Have not seen much movement, candidly, in terms of valuation. We're lucky because we can deal with companies that aren't necessarily squeaky clean perfection. With operating capabilities, you can view that as low-lying fruit. So, we don't see much of a change in terms of multiples. I wish we did, but we really haven't.
Is that just investment bankers pushing really hard, or what is that? Like, I mean, there's obviously
it's a quality issue. If something's good enough to transact, then it's still a bit of a scarcity relative to demand.
Scarcity, yeah.
Okay. Yeah, Heather, do you want to add to that?
Yeah, I'll add to that because, that's exactly right, Glenn. We're the businesses that are coming to market right now, and we're services focused first and foremost. So most are been essential businesses that held up okay during COVID. And it's a scarcity problem, supply demand imbalance like it was pre-COVID. But now you've got people who took 6 months off potentially and really want to deploy that capital in situations. I'll give you a great example. There's a residential services deal out there, and that's a really hot sector right now. But whereas, businesses like that may go in the low double digits, we're seeing upper double digits, companies that have just a little bit of scale. And by little bit of scale, I mean like 7 to 10 in EBITDA. And big funds are coming down market because if they pay up, they're putting, honestly, enough equity to work in those companies, and they have the playbook to build a national business. And so, yeah, I don't see valuations for quality businesses, which is most of what we're seeing right now, change. If anything, they're higher.
So I guess when valuations go up, return on equity has to go down. So how is a private equity firm just accepting a lower return on their equity, or are they using more leverage, or how does that math play out?
An awful lot of the market has accepted lower returns, especially when you have the pressure to put a large fund to work. That's why 9 funds later and 3 under Mangrove are staying small. So we don't have to take on the risk. For us, it's not so much a return issue, it's a risk issue. Paying a lot more for a company, unless you're willing to forego leverage, it's going to have a concomitant risk increase too. So for us, that sensitivity has more to do with risk than just returns.
From a private equity perspective, when you have a 10-year expansion like we had, every company looks really, really smart. And when you have a shock to the system, whether it's a pandemic or a regular recession, it kind of resets everything, and you really get to see who are the great management teams who adjusted, which business models are really essential and can withstand these kinds of things. And so those businesses that do well and have proven it out in those kind of circumstances, I think deserve that higher valuation because they've earned it. They've outthought and outworked other people, and it shows in these difficult circumstances.
Jeff, you make me think of something that no one likes a recession, but how refreshing is it when you're a year or two after a recession and you don't have to ask too many questions or be too hard to figure out how cyclical a company is. You just look at last year.
Got it.
You look
Yeah.
silly. How did you guys perform in 2009?
Exactly. You're like, I was a completely different business. How is that even relevant? It's true. I will make one comment on EBITDAC because I think a lot of people, that was a really hot kind of acronym earlier in COVID when people thought this was going to be like a one-time thing and then we'll be done. Not sure why we all thought that, but in retrospect, but we're not seeing that, especially on the buy side when we value businesses. I mean, some banks are trying to put a little bit in there, mostly for labor expense related to PPP loans or something like that, but nothing astronomical and nothing out of that would just be outsized. I think we're addressing it more through structure than we are through trying to define an EBITDAC multiple or waiting on the sell side to sell something until Jeff's point. We can roll off March, April, and May, but this is continuing and the impact of it is ongoing and uncertain. And so it's tough to say it's a one-time add back.
Yeah, and you're seeing it impact the businesses again. I mean, we started seeing it at the end of October. Our businesses had largely recovered and they're saying, okay, we're gonna end up about 5% off our budget for the year. But now they've kind of walking that back because of the spikes and the shutdowns here in Cleveland, Ohio. We actually have kind of a stay-at-home order again between 10 p.m. and 5 a.m. starting tomorrow for 17 days.
Yeah.
Not that we're conducting business between 10 p.m. and 5 a.m., but it's just it's a confidence reducer. We have a group of dental practices and more people are canceling just basic cleanings because they can and they're nervous.
Yeah.
We had
Hey,
one of
Heather,
those.
just going back to an earlier point you made just around multiples, like, and multiples are always relative compared to, what industry you're in and what EBITDA you're looking at. But what EBITDA are you talking about? A multiple of, trailing 12 months or a multiple of forecasted next 12 months? What EBITDA are you guys typically throwing a valuation multiple on?
Well, there's a difference between what we're doing and what the bankers want us to be doing.
Okay.
I think, there's a lot of run rate conversations out there. There's a lot of pro forma run rate conversations out there. There's a lot of give me full value for add-ons I have under LOI happening. And I would say, it depends on the situation, right? We want to know what LTM EBITDA is, and we want to see the bridge between LTM and what they want us to value it off of. And we have to be really confident and there has to be clear evidence that that bridge happened or exists and can sustain itself. But we submitted a bid this week for a business with $9 million in EBITDA. They had 2 companies under LOI. One's not going to close prior to the close of this deal, but the other one will. And so, they asked us to give full credit to that LOI, and we did. And some are doing it even if the deal won't close, but if it's imminent, they are. So.
Mm-hmm. Glenn, what are you seeing?
It's totally dependent on the specifics, and you're just trying to drill down into what is real and what is reliable. Is this something that's going to last, or is this a solar flare that you can't count on? And you just have to use logic and figure it out. So many variables that go into it.
Jeff, going back to a comment that you made around, this time kind of shows great management teams and what they can deliver. Maybe give us your, what you see as common characteristics of great management teams that you invest with.
Yeah, no, I had mentioned forthright trust. I want to hear as your partner, I want to hear the bad even before I hear the good. And having partners that have the confidence and ability to do that is important. For us, in what we do, we're working with founders who are kind of stuck and they really want to grow their businesses. It's finding those founders that are willing to try new things, where they trust us as their partner, that we've done this, over 20 times, that we really have seen the movie before. If you think about the early phases of a business, there's a lot of trial and error that goes on, and let's try this and back up and try this and back up and try this. When you have a partner like us, as it relates to business processes and this 5 fundamental methodology that we have, we have certainty about business processes and what the best practices are. Now, this isn't a cutting edge philosophy. This is just everybody on this call and dialing in knows that you need to be doing well to be a successful business, and their willingness to just adopt our best practices quickly and get in line is really important. And then the next thing I would say is, you know, a lot of the people that we work with by their nature are mavericks. You know, they have this extra level of risk that they're willing to take and push back, and they don't want to have a boss and all that other sort of stuff. But we need to find partners who respond to the things that we say are important. So for instance, when we talk about a monthly financial package, or we talk about coming back to the board of managers for approval on a dollar amount above a certain threshold, you know, those are certain things. It's not that we're trying to be corporate, it's we're your partner. And some people intuitively get that, and those partnerships work out really well. And then other people just are so used to being a maverick and being on their own that they just kind of continue on. And we either can coach them up to say, hey, we're your partner, and the spirit of the agreement is we share in all major decisions, or they don't get it and the partnership doesn't work out.
And maybe that's a little bit of the value as well. You know, you called yourself kind of the farm system for the major leagues, just coaching those management teams to when they, you know, there is that second exit to be ready for what that next partner is going to need.
Yeah, I mean, if you think about the deals that we do, the deals that Glenn and Heather are in, their founders and their businesses figured out how to get further along than our CEOs and founders did. And so we've come up with this methodology that we call the 5 fundamentals. And again, it's nothing cutting edge. It's all the basic building blocks that you know you need to do, but we need that because we are trying to coach up our CEOs and work with them on different aspects of their business so that they can grow their business and maximize the value of that business when they ultimately decide to exit.
Mm-hmm.
Jeff, you described it beautifully. Those inflection points and getting stuck, it happens at, you know, $1.5 million. It happens at 3. It happens at 5. Maybe not quite as much beyond that. I don't know, Heather, you can opine, but it happens an awful lot in our world, the $3, $4, $5, $6 million EBITDA world. They reach those inflection points. And you're absolutely right. The self-aware owner operators are the ones who they're not as prideful. They're not holding everything quite as close to the vest, and they're open to people that, you know, have done it 140 times to help lend focus and to identify the vital few things and provide tools that'll get them there. But if they're not self-aware, it's not happening.
Not happening. I'll add a little bit of a different spin to this, because since we have a buy and build focus, we've reached a lot of those inflection points, Glenn, because as you move and scale quickly with lots of rapid add-on acquisitions, those inflection points happen really close together. And so, you know, part of sort of a unique challenge and opportunity that we have is to build the right management team to undergo that growth. And so we're really looking for a CEO. Ultimately, when you want to get that flywheel spinning for add-ons, you want that CEO to spend 80% of his time on M&A. So you need someone who's got a network, who understands the industry, who can really be approachable and convince these business owners. Because now that we have the flywheel going, we're getting, you know, people are reaching out to us to sell as opposed to the other way around. And then once you have the, you know, but in order to have that happen where the CEO can spend that much time on M&A, you need a really solid COO, and you need someone that can integrate 5 to 8 acquisitions every year. And that's a unique skill set for someone to have. And we want people who have done that repeatedly. And then finally, corporate development, business development, someone at the company who can help with diligence and the execution of a lot of these add-ons to take some of that off the plates of my partners on the execution side. And I'll give you a great example. Alberio just hired our energy efficiency services platform, just hired a former associate at Huron who had been hired by an Audax portfolio company to do this exact job. And we stole him away and brought him into Alberio. And it's been night and day in terms of, how he's managed to integrate himself into that role. And so that's been great. And we have a great CEO and CEO on board now at Alberio. And, you take a $2.5 million EBITDA business, which is what Alberio was to start, fast forward 16 acquisitions later, and we've grown that business 20-fold. And so, but in order to do that, you really got to set that management team up early enough to make sure that you can get that flywheel spinning.
Yeah, I've seen that too through my career, where the founder that takes a business to $10 million shouldn't be the same person that takes that business to $50 million. So it's different skill sets and different expertise that's needed at different stages of the business. So it's great to get all three of your perspectives on that. Glenn, this is going to be a really self-serving question, but what can investment banking firms, what do they do well when they market a transaction to a private equity firm, and what can they do better?
Right. Well, it is from my perspective, so just same as the investment bankers always. But to us, our sensitivity really has to do with the fact that bad news doesn't age well. So if they're in the lower middle market, you see it probably more often than in larger banks processes where there's a landmine and it's just not discussed, but it's going to be discovered. And if folks know about it, they sure should share it as early as possible, just to lend efficiency, because the end result, I think, is the same, but being very, very candid. And I think sometimes a bit of a nit on my part, perhaps, but being paid by the pound is not the way it works. I don't think so. Brevity is okay in materials and in a sim. There's a tendency to repeat the same thoughts in a sim, and it's nice to be efficient.
That's an interesting point, and I've heard that actually quite a bit from private equity firms, where you don't need an 90-page sim to get the point across, and a lot of it's going to be discussed and kind of uncovered during due diligence. Heather,
I'll add on to that real quick. This is self-serving on my part because I read a lot of teasers from investment banks, but I guess I would ask that if there's an issue that is going to be an issue for a private equity firm that's pretty binary, like customer concentration or automotive end market exposure or whatever it is, like the cyclicality, oil and gas, like there are people that have absolute deal killer things about it. And it's really helpful if you just call those out up front, because it saves you time, it saves me time, and that's just a wonderful thing.
So just being upfront with what some of the challenges might be, right in the teaser, Heather, or
in the teaser or in the email that you send, the intro email. There's sometimes people disclose, and the other biggie is situation, and sort of who owns it and why they're selling, and sometimes that is important to people as well.
Yeah,
to be disclosed upfront.
And maybe like appropriate transaction, like what the owner is looking for in terms of transaction. Is that to be clear about that?
Not as much, more just that it's founder owned or family owned or private equity owned. That is relevant.
Okay, Jeff, what do you think?
So we see, as you might expect, a wide variety of sophistication. Sometimes we work with very sophisticated investment banks that are doing a favor to somebody because it's too small, or we're really just dealing with finders. And I most of the time what happens is the broker isn't adding a lot of value. We try to get around them and go direct to the company, as soon as we possibly can. I do think that they have an important role to play in terms of setting expectations of the seller in terms of valuation. I think they can play an important role in the communication, in negotiation, saying, hey, I've seen this before, this is market. Most people don't know what market is, and they haven't hired an attorney that knows what market is in our world. And then the last thing, and it's crazy to me, is that so when you negotiate a deal for the audience in a purchase agreement, there's a series of schedules that go along with the purchase agreement. And normally we are doing the schedules for the seller 80% of the time, where the broker just doesn't, advise through the close of the transaction. They really just kind of call in to find out when they're going to get their fee. Why that's important is because in the purchase agreement and the negotiation, particularly around reps and warranties, there's a lot of risk shifting that goes on, where I can hold the seller to a higher standard than they might otherwise be comfortable with. And I think that the advisors, brokers are doing their client a big disservice by not staying engaged through that process to the very end.
Mhm.
But one little nit, and it's specific to COVID. Heather, you mentioned the beauty of having a very efficient event where you had the lenders meeting en masse in one management presentation. As a private equity fund, we've experienced very recently where the target company management visit was en masse as well. So it was, 5 of our, or maybe 15, I don't know, of our closest friendly competitors, and we asked the questions. That, in all honesty, didn't work very well, because we really weren't in a position to learn what we needed to learn the way we would with one-on-one, whether it's virtual or better yet in person. It wasn't as helpful.
Yeah.
Was that because you were maybe hesitant to ask the questions that you really
can't
wanted?
ask questions. That's the problem. It's not one-on-one, it's one-on-many.
Yeah.
But I would say to that, Glenn, is there's a benefit and there's not the benefit. And you obviously pointed out what doesn't really work. But I think what does work is if you introduce it early enough in the process, pre-IOI, and you allow people to listen to and hear the management team speak, even if for an hour en masse, I do think that can improve someone's conviction. So that may help us maybe just tweak our IOI a little bit higher, or just have more conviction to bid up. Or if they do the one-on-ones, and then the one-on-ones get introduced kind of post IOI, and this concept of a virtual management meeting post IOI has happened. And I think that's helpful because then to the banker, because then after the virtual, they usually do a refresh IOI bid. And so that's actually helpful to the banker, because what they're doing is they're narrowing in on, the highly interested, highest quality group of buyers. And they're probably doing the owner or the seller a great service in bringing kind of the most likely buyers to the table after that point for in-person management meetings. Mm-hmm. And so I do think that concept of virtual, I hope, sustains to a certain extent, because I do think it's helpful to kind of both sides.
Does it help you get through deals a lot quicker, just doing things virtually, where instead of maybe hopping on a plane, you do initial meetings virtually and then realize that it's not a fit, so you move on?
Yeah, both ways, right? It helps you either gain more conviction, or you're like, yeah, no, I'm out. That's okay.
This may be a function of having operations and the understanding of operations in the DNA. And Heather, I know you guys are very operationally intensive too, but we really need to do a deep dive and understand. And if you can't ask questions, then that becomes challenging. I like the efficiency, but not if we're not learning what we need to learn.
True.
Thanks for sharing there. Again, that was super self-serving, and I was taking a lot of mental notes there, so I appreciate it. Just our last question before we get to some audience questions. So, there's an estimated, $1.5 trillion of private equity dry powder, globally right now. How does a private equity firm differentiate itself? This, capital is so ubiquitous right now. What's the differentiator? Heather, maybe I'll start with you on that one.
Yeah, I mean, Glenn hit on it a little bit. So, look, 10 years ago, operating partners, not on the payroll, but off the payroll, maybe on portfolio company payroll, was the trend, right? That was the differentiator. And that is very commonplace. So that really isn't anymore. So what Huron has done is we brought a subset of our operations team in-house, fully dedicated to Huron. It's, prospect companies and portfolio companies, where we've got the former CEO of Herman Miller, who's the head of strategy. And that is pretty, I would say, pretty differentiating when you're sitting in front of a management team and you're telling them about the people that they're going to get to work with through a value creation strategy and execution plan. And that's awesome. I also think specialization is starting to become actually more and more, what's the word I'm looking for? Essential. where that people just love that because, and I think private equity firms need to be self-aware enough to know, especially at my end of the world, that, you know, where there are, you know, one person that may specialize in, you know, HVAC services, there's probably 10 that have bid on 5 deals and lost, or have platforms or sold platforms. And like, look, bankers are going to them before they're going to anyone else in a process. And you may not even get a look for a deal because there's 10 people ahead of you who have already registered interest 100 times over about that specialist, you know, that sector. So I think that's truly differentiating. And then finally, you know, some of these CEO-led strategies are really interesting. I mean, we have one called Exec Factor, and it's differentiating in that it allows us to maybe start a little smaller, where, you know, there is a buy and build happening, but we're able to get conviction because we've underwritten that industry along with the CEO, and then launched a search to look for an operating company. So, you know, all of those things are differentiating today.
Just follow-up question there. What typically comes first, the operating partner and then the strategy, or the strategy and then you go out and find an operating partner?
Well, it depends on the operating part you're talking about, but are you talking about the ones that are kind of off our payroll that are sort of like the 40 to 50, or are you talking about the 4 to 5?
Yeah, the 4 to 5, the 4 to 5. I mean, do you develop the strategy and then go find the operating partner?
No, so those guys are kind of functionally focused.
Okay.
The operating partners we have that are off kind of payroll are industry focused. And so they serve kind of 2 different purposes. And so the functionally focused guys are great because they have a lane, the strategy guy, the performance improvement guy, the HR guy, you know, and that the capital markets guy. And, you know, they're able to serve sort of across the process continuum, you know, from the beginning of pursuing the deal to post-closing and executing on the strategy.
Okay, great. Jeff, what's your differentiator? And you know, is it just, you know, that there aren't a lot of players in that smaller space, and they kind of,
Yeah,
you know,
I mean,
venture capital to, you know, directly kind of, you know, mid-market private equity?
you know, frankly, mine's the easiest because there really aren't that many people. I mean, I'm not saying there's none, but a lot of our competition are individuals that are getting an SBA loan. So having a committed fund is kind of our hammer, you know, because there's a more certainty around getting the deal done, as opposed to waiting for the SBA to determine how much they're willing to lend, you know, an individual. But with respect to, you know, the broader private equity, yeah, $1.5 trillion is a ridiculous amount of money that would move GDP in the United States, particularly if you put some leverage on that. But you have to remember that you've got different investment strategies, you've got different size companies, you've got different focuses, geographic focuses, or different industries. So it does get segmented out. And so I think you need to kind of dig deeper to kind of figure out where the really crowded space is in that market. I think Heather really pointed out a couple of really important points, because at the end of the day, a lot of it just does come down to the interpersonal connection between, you know, the founder and CEO and an operating partner, or somebody that might be at Huron or Mangrove or something like that, that really makes the difference. It really does come down to the people at the end of the day.
Mm-hmm. And would you find another competitor of your deals being high net worth individuals that, you know, were once entrepreneurs and want to get back into it?
You know, well, the smart ones, actually, what they do is they understand what they did well, and they try to apply that to what they do well to, you know, their investment strategy. I do see a number of really wealthy people that made a bunch of money in real estate and then decide they're great at manufacturing or SaaS companies or something like that, and that's a problem for them. But for those that were really good, let's say at marketing, consumer products, and then that's what their focus is, they tend to be much more successful and very good competitors to somebody like myself.
Mm-hmm. Glenn, maybe share with us what you're thinking on how private equity differentiates itself with, again, so much capital. You know, Heather and Jeff did a great job of providing some examples, but I'd like to hear your thoughts.
It certainly has changed, you know, over the last 30 years. First off, you absolutely have to differentiate yourself, or at least personally, I would be loath to try to start a middle market fund anyway, and not have a differentiator. And it's hard enough in the lower middle market without a differentiator or differentiators. And I've beat the tambourine pretty loudly about the power of internal operating partners. And again, we invested half the ownership in this team. And I think probably a graphic example of it is what it's like when you sit down, you brought in, and maybe it's a beauty pageant, maybe we're one of a dozen people, and the owner pulls you aside and says, "I'm really glad they brought you guys in." I'm like, "Well, great, we are too. Why?" He's like, "You wouldn't believe the people they paraded through here. They're a bunch of financial engineers." And there's nothing wrong with financial engineers, but the dialogue is totally different when it's operator to operator, maybe engineer to engineer. And the dialogue is excited, it's enthusiastic, it's showing an understanding of the right questions and the right attempt to learn from the owner what he knows better than just about anybody or she does. And it's just a different dialogue, and a greater level of trust builds quickly. And I'd say, you lighted on it, Jeff, culture is huge. Part of it's this sort of operator to operator thing, but it's just who are you as human beings? Are you somebody that they come to respect, like, and trust? And it's different types of folks out there. And some folks tend to be quickly entrusted as people that they can trust and people that they believe will pick up the mantle with them and help them to reduce risk and just build value based on experience that they've had.
Yeah, follow up on that. I've heard the term, that deals nowadays are really well banked, but are the right deals finding you? Like, do you feel like, maybe the process is being too broad and going out to parties that aren't the right fit? Glenn,
There's so many different sizes and types of intermediaries and different sizes and types of companies. And it's sort of a taxonomy of a ladder, if you will. And some deals are much quieter, and the companies are maybe smaller or a little more complex, and it's full spectrum. And we're intellectually honest with ourselves and everybody else about our likelihood of winning a very, very robust professional process for a sizable, squeaky clean, perfect company. It's not that great, honestly, but there's plenty of data points that are below that, if you want to put it that way, where we know it's time well spent, and we think we can be good partners.
Okay, get on to some of our questions from our audience here. So there's one question just around COVID, and it's has it affected your appetite for cross-border deals? Are you guys, again, self-serving, but are you guys looking at deals in Canada or other parts of the world? Heather, we'll start with you.
Yeah, I mean, we're closest to Canada, I suppose, up here in Michigan, but yeah, that's been hard for us. I would say yes, it has impacted at least our pursuit of transactions in the nearer term. But I would say, the foreign exchange component of it has also sort of tempered our interest as well, particularly on the non-control side, where we don't necessarily have full control over when a sale happens, and so we just can't time it right depending on that dynamic, and so. Yes, I would say, unfortunately, it has in the near term, but, I think we're still very interested in pursuing deals, over the long term.
Mm-hmm. Jeff?
Almost not applicable.
Okay.
You don't do it anyway.
We've looked honestly at stuff in Ontario a number of times, and we've just never been able to get a deal closed. It's not for lack of interest or trying, it just hasn't come together. So I would leave it to Glenn to fill in the blanks.
Glenn?
We've had the good fortune of doing some successful deals in Canada for platforms. That's the only foreign land where we're going to be active. Add-ons, we can go anywhere in the country. And I'd echo what Heather said about challenges of probably traveling internationally right now, other than Canada, if the rules allow us to.
It is important to be close to the operating company, or what are your guys' feelings on that?
Not particularly.
Okay.
Yeah.
We're a lunch pail crew, man. We got to do the work.
Got to find deals anywhere.
Sure. Awesome. Well, we're up against the hour here. Guys, I really enjoyed this conversation, and I really appreciate your guys' time in joining me today and our audience. So thanks again, and maybe we can do it again someday.
Thank you.
Thank you for having us.
Really
Thanks,
appreciate
guys.
the opportunity. Take care.
Yeah.
Stay safe.
quick reminder
Right.
that we'll send out contact information and an email to all of the attendees. So if they want to contact Heather, Jeff, or Glenn, we'll provide and share contact information for everybody. So awesome. Thanks again,
That's
everybody.
great.
Thanks,
Thank you.
guys.
Bye-bye. See ya.